Hey folks, welcome to Pro Trader Strategies. We are doing swing trades using options. So if you guys want to learn a little bit about how to trade around a swing trade, you're in the right place. And further, if you want to increase your probabilities of success trading, we're going to be using options. So you are definitely in the right place. Throughout this video, I want you to comment over there on the side. I want to make sure you folks are clear of concept. If you guys want me to run over something again, throw it over there. I'll even circle back around after this webinar is done to make sure everybody's clear of concept. You folks that didn't get an opportunity to watch this live and participate. Also, smash that like button for me if you would. It's kind of like you're feeding those little robots or the crawlers out there in the interweb. And what happens when you hit that like button, it throws them a cookie and they run out there and try and find somebody just like you. So let's get those bots running all over the place, smashing that like button. And finally, subscribe down there at the bottom. There's a little bell. I do market commentaries where I talk about spotting the trades that I find on any given day. And I might pop in and announce. So if you have that bell click, you'll actually know when I'm coming on to talk about trades that I'm implementing on any given day at any given time. All right, so without further ado, let's get on with this. This is swing trades, and a little bit odd that we're doing swing trades on sideways trades, but you can still do that. There are opportunities out there when the underlying has made a big move and starts settling down. That's still a swing trade, folks, and we're going to show you how to take advantage of an underlying that just is boring in trading sideways. So sideways moves. But before we get on with that, we're going to talk about swing trades using options. One of the things we're going to talk about here is the short straddle. That's one of the better ones to trade for a sideways market. It probably also is one of those option strategies that people are the most afraid of because you're selling two at-the-money options. That can be a little intimidating, I'm not going to lie. But we are going to build from simple concepts to real life examples. And by the end of this, I'll show you how this strategy actually has a high probability of success, despite the fact that you're selling those at the money strikes. So before we get really on with the short straddle, because we don't walk into any day saying, hey, you know what? I need to throw on a short straddle today, so let's do it. No, we have to look at the markets and it leads us to that. So in these videos, I like to do that, just that, where we build from a real life example where we come up with a directional assumption on a given underlying, and then that ultimately leads us to the right option strategy. So we're going to try and do that here today. I'm actually using the example that we used last week on the short strangle. The next day, if you were watching those daily market commentaries or the spot the trade videos, I was actually implementing this strategy around the same underlying we talked about yesterday. Share the screen, I'm being told. So a little bit bigger, I'll make it for you folks so you guys can see it. Let me make sure I can get that. There we go. Is that a little bit better for you? All right, swing trades first though. What is a swing trade? A swing trade, folks, is just literally trying to determine an overall move in an underlying. So what we try to do is determine if it's bullish, market neutral, or bearish, right? That's the first step, is to find the overall trend. So in this case, we can see that this is a very bullish trend. Here we have our sideways trend, right? And the next one is the example we're going to look at that is also going to be looking more like a sideways trending underlying. Sorry, I'm getting a little ahead of myself there. I'm missing one of my slides, so we'll go back to this one. So first thing is finding the trend. Pen. Sometimes it wants to stay on, sometimes it doesn't like to stay on for me. Let's go back to the pen. So first thing we do is look for the overall trend, all right? So that's the first thing we're looking for, whether it's a bull, market neutral. Today we're looking at more of a market neutral, but just for examples, a bear trend. And then the next thing we have to do is find support and resistance, all right? So what we're doing is we're looking at what this underlying is doing, and we try to find resistance and that support level. Same thing with ones that are market neutral. Find resistance, find support, and again in the bears, right? So those, you can really kind of look at an underlying and glaze your eyes a little bit. That's the easiest way to see the overarching trend, but you'll also see where it loses momentum to the upside and gains support to the downside. That's ultimately what we're going to base our trade on, is the pattern. This is the pattern within the overall trend. So in this case, what we're looking for is a bull. Here we have a bull overall trend. We found the support and resistance, but then we see that there is a bearish pattern inside of this move. So that's what we would set our bearish trade up on in this underlying, in a bullish pattern here. We got a bullish pattern there and a bullish pattern there. It's not always exact a bear pattern with a bullish or a bull pattern, let me restate that. A bullish trend with a bear pattern. We could have a bullish trend with a bull pattern. It's just a simple example. But ultimately, we are going to base our trade on the overall pattern within that trend. Does that make sense for everybody? Like I said, feel free to reach out over there in the comment section. If you are at all confused or have a question, somebody else out there probably has that same question. So please throw it out there, participate. Also, when you comment, it feeds those bots also. So feed the bots, feed the crawlers. All right, so again, like I'm saying, we can see that this one has an overall bullish trend here, right? Sorry, I don't know why. Before I started videotaping, I got the pin to stay on here. So we've got a bullish overall trend, right? And, you can kind of glaze your eyes and see where it's bouncing on these supports. Now, one of the things is it didn't quite come down and hit that trend channel, but we can see that we've got a pattern that is looking to set up for a bullish move here. All right. So in this case, you would have a bull trend with a bull pattern that you would be setting up a trend on, or a trade on. And here we could see where we have glaze your eyes overall sideways trend or neutral trend. And again, make sure I got my pen. I'm starting to remember now that it doesn't do it on this. So then we would just kind of do this with our eyes, right? And overall try to figure out, we've got a sideways trend with a bear pattern setting up, okay? Now, some of you folks might be like, how the heck is he figuring out that there is a bear pattern being set up here? What I'm trying to show, what I want to see here is the fact that we have a specific candle here. So these are the things we're going to be looking for on momentum reversals, whether it's at the top of a move or at a bottom of a move. That's where your key is here, folks. And the candle in question here looks very similar to this, right? So we're looking for like a hammer doji is what that's called, a spinning top doji where it's got a little bit of the wick at the bottom, hangman doji, all right, things like that at the top of a move or at the bottom of a move. And folks, it doesn't always have to be a red one, all right? It can be a green one as well, looking like this. This could have been a green candle that looked very similar to this at the top of that move. That would have been your first indication that the market is looking to roll over here, okay? And as you can see, very similar patterns here as well, okay? So those are what we're looking for. You could even see something where a engulfing candle reverses that momentum. But for newer traders, look for candles that look like this or this in red or green at the top or the bottom of a move, okay? You could also see one, I don't have an example, but it looks like that. That's called the Tombstone Doji, which also is a signal of a reversal in momentum. So that's what we're looking for, and that would have been an indication for me to try and play something to the downside. One is it came up against that resistance area as well. Another one that I'm looking at is XLU. Why? Because XLU has been in a pretty much sideways trend for a while here, right? So when we're looking at this, we can see that it does make some big moves to the upside, but then what happens? We see it trend sideways. Big move to the downside, trend sideways, right? Down to sideways. Big move to the upside, sideways. All right. Now we've got another big move. I'm expecting another sideways consolidation here. Another thing we have going for us is I trade around the market profile, which is this blue area over on the side. It tells where the time and volume has been spent, where most traders are transacting. That usually becomes an area where it settles down. If you think about yourself, if you bought an underlying, say a stock, and it stays right where it's at, well, you aren't really angst in either way, right? You're not losing money, you're not making money. And that's usually where everybody starts feeling a little bit of the pressure. You're losing money on an underlying, you feel that, right? Even when you're making money on an underlying, if it's made a big move to the upside, you feel like you need to either cover it for a winner, or if you're short, you'd cover that for a loss in a sense. So when you get spread out away from the comfort zone, that's when you start getting those big spiky moves. But when we're stuck here in and around an area where it's getting comfortable, the point of control in this case, then that is where we usually see volatility come out and the underlying trade sideways. That's where we can take advantage of something like what we talked about with the short straddle. So we're going to look at this as an example. This was a snapshot from last Thursday when I did the example on the strangle. And then the next day I went out and did this on the straddle though, because really the rules are very similar. Or at least my guidelines for that. All right, what happens though? We'll see it break through that resistance every once in a while. For instance, we're talking about a trade where we set it up around this particular candle. Now, newer traders should always wait for this candle to get confirmed. And what I mean by that is you don't, if you're a trader like myself where you have a higher risk tolerance, then you might jump on this trade a little bit early. But if you are a newer trader, wait for this underlying to see a candle that closes below the low of the previous day. So for instance, in this case, we've got a candle that looks very similar to this, right? The next day you would want to see the red candle kind of peel down and at least settle somewhere below this dotted line, okay? So that would be more of a confirmation. Obviously, if it gets, the further down it drags, then more of a confirmation it is really. But the rule is if it's settling below that previous day, that's where you're looking to get into this swing trade. But notice that another thing with this, it doesn't always come up and hit like a resistance area. And sometimes if you use this as a resistance, which I would, a more aggressive trader might use this, it doesn't always come up there and really hit on that resistance or drop to the support level. And when you're doing a swing trade with an ETF, or a stock, a future, the real rule is to wait for it to hit that and repel away or break through it. And then when it comes back into that area, that's when you start initiating your trade. But with options, because we have a higher probability of success, we can implement these strategies a little bit more aggressively. For instance, if I was getting short calls, my strike location might be way up here. So I can get involved in an underlying that comes up very close to it and starts getting repelled. So I can implement more strategy. I can play this game more often by getting involved in this. But we do see that sometimes the underlying will pop through. Now, something to note, this one didn't get confirmed. So that's why the market blew to the upside. Now, if you got involved in this underlying on that candle, as soon as it looks to settle above the high of the day, that's where you're pulling the ripcord on a trade like that, okay? And very similar. Anytime you're setting up a swing trade, the idea is that you're getting out on the previous day's high, okay? on a swing trade. So you can see that it broke out and above, but when I talked about this strike location being up here, selling calls above that Fibonacci line, it got tested when we talked about this in my spotting the trades and had this trade on, but it came up and had another very similar and got confirmed to the downside, as you can see there. So I stayed in this trade. Despite the fact that it did pop up there, it never came up and really put the thumb screws on me on my strategy. Whereas if you had gotten involved in this as a stock, then you would have been not quite so happy. You would have been stopped out more than likely. So you guys have got this, right? How do we swing trade? First idea is we identify that trend, right? And whether or not, is there something I got to do to identify the trend, identify the support and resistance, and then the pattern. So, right? Overall trend, are we bullish, market neutral, bearish, right? Support and resistances, that's where we kind of look at the underlying and try and draw our lines in there. And then ultimately, the pattern is what we set the trade up on, okay? When it bounces off of those support and resistances, that's where you can make those quick moves in the other direction. All right, so why options? I kind of mentioned this earlier, right? You have, well, here, I'll go back to this and just write them down for you. You have better odds. So better odds or better probabilities really is what I usually say, but I don't want to write probabilities all the way out. So you have better odds. You also have less risk, right? Even with this strategy, we really have less risk than another underlying, right? If you have a long stock and it doesn't go anywhere, well, you have risk on as that money is not being worked and making you money, okay? That is a risk. If your money is sidelined and stuck in underlying that doesn't do anything, that is a risk. It's opportunity lost, okay? And you're going to have lower margins, which is huge. I mean, even if we could create a situation where you wanted to buy stock, hey, I like buying stock and selling stock, all right? Well, because you like the risk reward on it. We have option strategies that mimic an underlying dollar for dollar. And I show you how to set those up. It's called a synthetic long or a synthetic short. Synthetic short's much better than going out there and borrowing the stock. And the synthetic long, you're probably, even if you're trading on margin, is 50% less margin using the options to create that synthetic trade. Okay. So better risks with options. All right. And even with this trade, selling a straddle, having the underlying pop up there to that level, then you could have taken advantage of that high implied volatility, because we see IBM has a tendency to always migrate back to right around 100, folks. I've been trading IBM since I was in college, and I'm dating myself. We're talking back to the 90s, folks. IBM was still trading 100. I have stories where I bought IBM and Walmart back in the day, and IBM hasn't gone anywhere. All right, so let's take a look at this underlying for IBM. We can see that when it broke out on this trade, which was right here, I think. I don't know why I broke this out, but this was that second move. This was the breakout. This was that second move. But the idea here is, even on this underlying where the short calls happened, it got up into another level and traded sideways. Those short calls were still profitable. But the idea also is, this is very similar in nature to what we're going to be looking at with XLU, where if it makes that incremental move, it has a tendency to trade sideways. And IBM is one of those ones where, if you guys watch those spotting the trades, I always kind of fall back on IBM because it's such a great underlying to trade, especially if you have long this stock, to do covered call strategies on this. It's a great way to get an extra dividend. But we're going to be looking at something with XLU. But what I wanted to talk about this again with this underlying, when we got involved in this trade for SPY, we were looking at implied volatility. When implied volatility is spiking, that's when we want to take advantage of collecting a credit, okay? Because we know those premiums are super expensive. Now, with that said, if I got involved in this underlying here, which is when we got involved with this high implied volatility and it broke back into the trend channel, that's what we were looking for on something like this for a swing trade. Believe it or not, with this high implied volatility spike, I was able to sell puts down here at the 415 level. I mean, think about that drop from basically here to here. That was a pretty massive move to the downside. Now, you would have made money had you bought this as a stock or an ETF in this case, but you would have also been feeling the pain on like a sell-off right here. You probably would have thought, all right, I got to get out, because that's one of those rules where it breaks below the previous day's candle. You got to get out. Well, in this case, we're still for one inside the trend channel, but the other thing is we're just watching this volatility come out. All right, and the underlying going in my direction. So I had everything working in my favor here. But what I really want you to take away from this is the fact that I was selling puts down at the 415 level on a bullish move. So, I mean, very little risk on this trade. Yes, you probably would have made more if you went out there and bought 100 of this underlying, but you also were incurring a lot more risk. All right, so let's go to this one. Again, back to the idea that I think that this underlying, this is a snapshot again of last week where we got this move to the upside, started looking like we're going to start trending sideways. Now, I got involved when I took this snapshot. By the end of the day, believe it or not, it settled near the high of the day. Probably would have picked different strike locations, but I didn't. I used the ones from the next day, which were a little bit further down. Now, we talked about this. What are options? All right. Options are just really two contracts. One's a call and one is a put. Those are the only two contract types of options, a call and a put. Now, you can buy them and you can sell them. All right. But the ultimate idea here is that options give you the opportunity, if you're the buyer, to buy that stock at that strike level. It gives you the opportunity. You don't have to. It gives you the right, but not the obligation, is another way to think of it. So if I want to look at an example here of a call, for instance, let's just go with XYZ. All right, XYZ is trading $100. Now, if I buy a call at the 105 strike, right, that call gives me the right but not the obligation to buy the stock. Now, get those levers and pulleys going for a second. I buy a call at 105. That gives me the right to buy the stock at 105. If it's currently trading 100, do I want to buy XYZ at 105? You guys can throw it over there in the comment section. I'll answer. No, of course not. Why would I want to buy a stock at 105 when it's trading 100? I can go out there in the open market and buy it right now. There's no value in it at this point. The reason why I pay for that stock or pay for that option is because then I have the right later on. I have the opportunity to. Jeffrey says no. But if this underlying shot up to 95, now XYZ is trading 195, and I still own that 105 call. I have the right, but not the obligation, to buy the stock at 105. Do I want to buy the stock at 105 when it's trading 195? Absolutely you do, right? There's $95 of value in it, right? From 105 to 95, there's $90 of value there. All right. So options, in this case, if it was in the money, the underlying had shot up to 95. Well, this in the money option has to reflect, now that it's in the money because it's below where the underlying is trading, it has to reflect that value in the difference from 105 to 195. The value of that option has to reflect that, which is at least $90. Okay. Now there's usually a little extra money added on there, and that's called extrinsic value. That's the theta decay. We'll talk about that here in a moment. So you never, especially in this day and age where you can buy and sell stocks for free, you never really want to go through the assignment process if you own the option. Why? Because you have to pay exercise costs and stuff like that. And believe it or not, those are really expensive. When I first started trading, the exercise costs were about the same as going out there and buying a stock. So it really didn't make that much of a difference. This day and age, if I were to get out of the 105 calls, right, I make that $90 to the upside. And if I get out of those 105 calls, I get to keep the extra extrinsic value that's still in there, that theta decay. It might be an extra dollar or so. All right. So I don't want to go through the exercise process really ever. Even if I'm short, I don't want that person to send me through the exercise process because it costs too much. You're better off to offset the option, go out there and buy the underlying. You will be ahead of the game because of that extrinsic pricing. Jeffrey, all over me over there. Inversely, if the underlying went down, those 105 calls I would let expire worthless. Why? Because there's no sense in me buying it way up higher when it's trading down, right? On the flip side, though, the seller of that has the obligation. So you can kind of think of it as if I'm the buyer, I'm buying insurance in a sense, so I don't have to go through it. But if you're the seller, it's kind of like you're the insurance company. If somebody comes to claim something, then you have to come up with whatever they're claiming, right? So the idea here is that if I'm the seller of the option, somebody comes calling to me, they say, hey, you know what? I want you to sell me the stock here at this level. You have to, okay? Or deliver your stock at a price that strike indicated. In this case, 105. All right. So the seller has the obligation. But remember, the seller gets to keep that premium no matter what. All right. Now, it's not much of a consolation when you're talking about a $95 move. But if I was able to collect, $5 or something like that for that strike, that's a nice little trade there, especially if the underlying trades sideways or goes down. I get to keep it. And the probabilities are the probabilities. And we'll talk about those here in a second. All right. The put buyer, on the other hand, has the right but not the obligation to sell the stock. So if I'm buying a put, it allows me to say, hey, you know what? You're taking my stock at this price. So if I buy, let's say I buy a put at the 95 level, right? And XYZ is trading 100. Do I want to sell my stock at 95? No. Stock goes down to 0, I sure do, right? And those puts will reflect from 95 to 0. There will be at least $95 in value there. And on the other side of the puts, the seller has the obligation to buy it. All right. So if I bought a put at 95 and this underlying goes down to 0, I say, dude, you're taking my stock at 95 and he has to buy it there. Okay. All right. Talked a lot about buying and selling options. Now we have to determine whether or not those options are cheap or are they expensive, right? We're talking about premiums, right? If I'm a buyer of an option, I have to pay something for that. And as a seller, I get to collect something for, taking on that risk. But those prices fluctuate all day long. And what we need to do is go over to the option montage to start determining whether or not these premiums are expensive or cheap. And one of the things we're going to be looking at here is in XLU. When I took this snapshot, we're going to be looking at one of the Greeks here, and it's Vega. So we're looking at Vega. Here's the puts, here's the calls, and we've got Vega on both sides. Now, what Vega tells us is for every percentage point increase, our premiums will increase by the corresponding coefficient there. So if XYZ, let's go to here, goes from 17 to 18, basically I would see these premiums increase on the 69 strike by 9 cents. 1 percentage point increase, 9 cents goes in there, okay? So what I want to do is look at this number and determine how many of those percentage points have been jammed in there, right? So it says 17. Now, I need to determine what 17 is. Is 17 high or low? Well, you can't really tell by looking right here on this page. All I can see is a snapshot of what it is right now. So I want to look at 17 in relation to where volatility has been in the past. And Vega is simply implied vol, okay? Implied volatility. You're going to see implied volatility in a lot of different places. Just know that when you go over to this one page, Vega is implied volatility. It's just a fancy name for it. So we know that as implied volatility fluctuates, our premiums in these option montage are fluctuating as well. All else being the same. The underlying doesn't move a penny, all right? We don't move a second, but we just see this underlying popping, or the volatility popping up and down. We would see our premiums going up and down as well, all right? So I need to look at 17 and see where it is for itself. So I like to go over here and for the underlying have XLU, for XLU in this case, and I have a chart of implied volatility here. So what I try to do is determine where this point is in relation to the high and the low, okay? So it's kind of like a swing trade in its own regard. When it hits those extremes to the upside, we know it's going to lose momentum because each underlying has a pretty range-bound area. Now, 2020 was a little bit crazy, folks. All right, volatility was through the roof. The last time we saw that kind of volatility, like in 2020, was guess. Anybody got any wild guesses on when the last time we saw volatility spike like 2020? Folks, 1984, all right? 1980, I think it was 1984. Anyway, and before that, it was 1929. Not even the financial crisis, not even the dot-com bubble saw the volatility we saw last month or last year. So I want to kind of discount that black swan event. So what I do is I'm discounting everything that's happened for the last 6 months on that volatility because I think we're coming into more normalized volatility. I think it'll still remain elevated, more so than maybe even 2019, but I don't think we're going to see the type of volatility we saw in 2020 because we already kind of know what's going on at this point. So I need to figure out where 16.5 is in relation. So let's zoom in on it. And for an ETF, I say basically, if it gets up in this 70 percentile, that's basically a sell zone. And if it's below 30% or lower, that's the buy zone, okay? That's for an ETF. Now for a stock, it's above 50, below 50. It's pretty simple. But for an ETF, because they get massive spikes because of a certain stock in that ETF or maybe a couple of stocks in that ETF, it has a tendency to pop back down, all right? So my rule for ETFs is the threshold is a little bit lower. So what we can look at this as is finding the range here. And we take the current implied volatility. And I have the script to put this over in your watch list if you want it. Minus the low. And I only do it for the last 6 months. Thinkorswim does it for the last 52 weeks. And then we take that sum and divide it by the range, the high minus the low. So you can kind of see what this is really trying to do is ultimately find out where the current is off of the low and then what that is in relation to the entire range. So we can say that we got the current is 16.5, 16.5. The low here, I'm going to call it 6, minus 6, right? And the high is going to be 35 minus the low 6. So basically, I end up coming up with 10.5, 10.5, 10.5 by 29. All right. So you can see that that basically puts that slightly in the positive there. So let's pull out this jumbo calculator and do 10.5 divided by 29. So 36 percentile. So that's above that line in the sand that I'm looking for at 30 for an ETF. So in this case, with it at 16.5, I was pretty comfortable with selling premium in this underlying, especially because I'm believing this underlying is going to go sideways. So I've got it in the 36 percentile. That's leading me to believe that these are at the higher or slightly more expensive. And if they're expensive, what do we want to do? We want to sell those options, right? Because you want to sell high and buy low. Be a good steward of your capital. Don't buy that premium just willy-nilly. I mean, a lot of these folks on, especially the Wall Street Bets folks, they're driving volatility through the roof on all of these things. It's because they're buying options. They've realized that they can leverage or use their margin more wisely, so they're using options to make these big trades, but they also don't really know what they're doing. So they're buying with double-fisted and driving that volatility up, all right? So we can take advantage of that by being a bit of a contrarian. All right. So if we have high premiums and I want to be selling that option, right, because I know that they're expensive, I want those premiums to go down. Theta, this thief in the night that comes and steals your premium, will help you out when you are selling an option. All right. So you want that in your back pocket. So one of the things we know about theta is it's not linear. It doesn't happen evenly. It's not like a dollar, okay? Basically what happens is he doesn't realize you're even alive 100 days out, and then all of a sudden he starts getting more aggressive once he realizes you're in the game. You can kind of think of it. And this theta will kind of level out the further it goes out in time. It's never going to flatline, folks. It will slow down though. And I'll show you another example of that here in a minute. So if you're buying options, we want to buy outside of 70 days to expiration because we want to avoid this ramp up. And if we're selling options, I like to say 45 days to expiration is where you start getting involved in them. You know, basically implementing option strategies kind of within this little area here, okay? Because we want this volatility to start really accelerating, okay? As soon as we put that on, really, right? Because as soon as I sell something, I want theta to start picking at it, right? And I don't want it to just take a penny. I want it to take nickels and dimes, right? I want that precipitously to drop. So I want theta on my side if I'm selling options. So this is our sell zone, basically 45 days and in. And, 21 days is kind of like where I start looking, all right, I'm going a little further out in time because a lot of that theta decay has already happened, okay? All right. So we're taking advantage of the thief in the night. Here's an example. Like we're looking at something that is not learning that he has to fix the pen every single time. So if we look out here in time, 100 plus odd days, 140 days, we can see that theta is about 6 cents. This is our theta for the calls, our theta for the puts. We can see it's always negative because you can't go back in time. These Greeks, folks, are always the assumption of an advancement, all right, moving forward. So delta tells us it's going to adjust on the underlying moving, and that's for a positive move. So a delta is positive for the calls. When the underlying moves higher, our calls get more expensive. It's negative for the puts because as the underlying moves up and away from our puts, they become less expensive, right? Less likely to get them in the money. So that's negative. theta is a day goes by, right? We already talked about volatility goes up by 1. Theta goes by a day. We don't have a DeLorean to take us back in time, so we can't have a positive theta. The only thing that we can do is make theta a positive to our position. All right. So we want it to help us out. So we can see it 149. And look, we've got basically 70 days goes by. How much did theta increase by? 1 penny. Didn't start hurting a whole lot. Now look, from 86 days to 58 days, let's call it as close to 30 as we're going to get, 28 days. It increased by maybe a penny and a half. It looks like 1 penny, but the ones that are in here are a little bit, maybe 2 pennies. So it's a rounding error. So it's increased by about 2 pennies. And then from 58 days to 23 days, so the next 30 odd days, look at this, goes from 8 cents to 12 cents. It increased by 50%, right? From 8 to 12, it increased by 50%. That's what we want to take advantage of, is that kind of, and this is 58 days out. You can see that that's that inside of that, inside of that 21 days. I don't know if I necessarily want to jump on that because a lot of the thetas come out. I might jump back here to this one and then take advantage of that ramp up in that run. Does that make sense to everybody so far? So if you got nothing to take away from that, when you're looking at the option montage, folks, just remember all of these Greeks have the assumption of an advancement of 1, right? A dollar move higher. Theta is a day goes by. Vega is 1 increase in the premium, all right? Now, if you get negatives, the underlying goes down, you have to add a negative to everything, right? A negative plus positive makes it a negative plus a negative makes it a positive, right? On puts, a negative move plus a negative delta makes that positive. It adds in them. That makes sense? If it does and you learn something, smash that like button. Feed those bots. Send those things out to find somebody else to tell about the Greeks. Delta is just data. Theta is the thief. And Vega is volatility. All right? It's that simple. Gamma goes with delta. I talk about that in some other videos. We're not going to talk about that so much today because we don't want movement. But Vega, in this case, we're looking for it to be at an elevated level, and therefore we know those premiums are expensive. Vega. And theta, we want to take advantage of the increase in his thievery. We can see here, 100 days out. Let's look at theta for the calls, the puts, theta. It's always negative. But we can see out here, and this is a lower dollar stock. One of the reasons why I wanted to show you that high dollar stock is so you can see a real solid example of that. But 100 days to 43 days, we can see our theta did not really increase at all. It's a rounding error. It did increase. You know it increased, and it increased, a multiple there. But you can see it didn't really show up even with the rounding. But when we look at 43 days, and again, this was last week, to the 15 days to expiration here, we can see that it doubled, all right? So we can see that that theta is working in your behalf. If you're selling options, you want to get inside that 45 days to expiration there. So the thief in the night, we've got high implied volatility. I've got a market neutral assumption. I want to take advantage of that theta decay. I've got really high premiums. I've got a pretty tight range. I'm going for the straddle. Strangle, I was worried a little bit about that underlying, make it a bit more of an outpaced move. That's what you're going to be looking for a difference here, is maybe this short straddle when you get that collection of credit doesn't quite give you enough credit to get your break evens to your support and resistances. So if that's not the case, you could go out there and sell the strangle and get outside of those support and resistances. That's when you're going to lean towards that strangle, okay? But the straddle, you're expecting a little bit tighter range. what's this? Selling a put and a call are at the money. Yes. As a matter of fact, you're getting a little ahead of me there, John David, but we are going to be talking about getting the strikes already. But first, let's talk about that delta, because that's what John David's talking about, selling the at the monies. The at the money options, those are a delta of 50. And what we said used to say on the floor is, don't forget to change your pen. Delta is just data. I mentioned this because all right, the definition here, folks, is it's the rate of change in the option. All right. So that's that dollar move higher. Our premiums increase by the corresponding amount. But what I'm talking about with data is it tells us the probabilities of being in the money by 1 penny at expiration. Okay. That's the key. So a 50 delta is a 50-50 chance of being in the money by 1 penny at expiration. Pretty simple. All right. With that said, when we were talking about last week with the strangle, we were talking about the 16 deltas, right? And that was basically selling a 16 delta call, 16 delta put, and anything in between there, we were golden. We'd get to keep that entire collection of credit. Now, what we're looking for with this strategy is, for one, it's never going to decay 100% because of the fact that we're selling 2 strikes at the money. It's never going to settle exactly 65. And if I sold 265 call and a put, it's probably never, ever going to sell 65. All right. And if it does, then basically both of those options are in the money for that matter. But what we're looking for is delta gives us data on probabilities of being in the money is what I want you to take away from that. All right. And when we were talking about this, it's the standard deviation curve. So when I am right here at 0, that is where the current underlying is trading. So this 0 is a 50 delta, whether it's the call or the put, folks, it doesn't matter. It's a 50 delta. And if you look at this as being positive, this is the call side. I'll just go calls and puts because they're negative, right? If I were looking at this line where it's a half a standard deviation, well, that's about a 36 delta. Why? Because if you add up all the probabilities of this happening, it's a 36% probability. You add up all of those. Last week, we were talking about this strike right here. This is a 16 delta, 1 full standard deviation move. All right. Because if I add up 9, 4, 1 and a half, and half, 0.1, all the way out to all the standard deviation moves, that would add up very close to around 16. So 16 delta call, 16 delta put, right? 36 delta, all of those things. We're going to be looking at these 50 deltas right there at the money, 50-50 chance of being in the money at expiration. And I kind of told you already, give me the strikes already. This is ish, folks, ish. All right. It's not always going to give you an exact 50-50 delta. The only way it would be is if it was trading exactly at your strike, right? And that still might not be exactly. And that has to do with some skew, but or extra put buying, extra. 0 level is where the stock currently is, correct. But that also is 50-50, right? Because if I add up 19, 15, 9, all of these all the way out, and we got to go to the 4 standard deviation all the way out. Basically, everything from here that way is 50% or 50 delta. Standard deviation, folks, and delta are the same thing. And if you add up all the probabilities going that way, that's 50. And it's a 50 delta. All right. Now, one thing we will notice with this is you can think about volatility and these these curves. I'm going to try and go to a blank one. is those standard deviation curves. When we were looking at that one, it looked kind of like all right, it kind of looked like this where it's pretty even, okay? So I say to folks, hey, look, this is a regular standard deviation curve. Volatility is like a big bucket on top of here. And when volatility is normal or equal level, then this is the kind of standard deviation curve we get. Now, if that bucket got really full, we might see this happen, right? Where this bucket is the same bucket, but now it's really full of volatility and it squishes down that curve. So when I was talking about those one standard deviation moves and stuff, doesn't matter where they are, but let's just say it's right there. One standard deviation to the put, one to the call. Well, if this was the same underlying, but it had high volatility, it squishes that curve out. And now our standard deviations might be a little bit further out on the option montage. Same underlying, but that volatility gets jacked up and it squishes, it flattens down that curve, meaning that the probability of this move is likely, okay? Whereas when volatility is like this, it's just saying probability is only of this. And then when that volatility bucket empties, it's going to look like this. This is like basically an empty bucket. All right. And now this one standard deviations are like this. Okay. So ultimately, you want something where it's got really high volatility, right? And then the volatility just empties out and the underlying didn't even move anywhere. That volatility curve snaps back in. Well, if I got involved in this underlying and that volatility snaps that much, remember that volatility coefficient is literally, when we're looking at implied volatility, it's like that. Just drops, okay? That's what we're talking about, going from here to here. When that volatility snaps down like this, our volatility curve goes, okay? Does that make sense? If a light bulb just went off, folks, make sure you're smashing that like button and feeding those bots. Get out there. Click on those bad boys. Comment over there. All right? Don't forget to hit the bell for the subscribe. But feed those bots. All right, 50-ish delta. Let's get on with this. So I'm looking at this underlying to trade sideways. I thought that might work. It didn't. Sometimes when I push, I got to figure that out. It's going to drive me crazy. All right, so I'm looking for this underlying to start trending sideways here. I'm going to be looking for something right in and around the 69 delta is what I'm thinking, because I'm expecting this volatility to start precipitously coming out. And if just that volatility comes out, tick, 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 I will see my premiums dwindle. All right, so last week when I was looking at this, we can see the delta. See, that time it worked. I don't get it. Calls, puts. All right. The delta for the puts is negative because a move higher would make those puts go down in value. But I was looking at the 70 strikes here, okay? With volatility went up just a little bit from when we were first looking at it, which is a good thing. That means those premiums actually increased by that 9 cents, right? Because it's about a percentage point higher. I know these premiums increased by that 9 cents. So that's the strikes I'm looking for. No, it's not exactly a 50-50 delta, but it's as close as we're going to get. So I'm looking at the 70 strike, collecting $2.71 for this. Now, what we want to look at is our max profit. Max profit, anytime you're collecting a credit, is always the credit. All right, so that's my max profit is $2.71. My max loss, folks, is unlimited. There is no defined risk strategy here. I'm short. And if you guys are trading in an IRA or a trading account and you want to mimic something like this, but have the defined risk strategy. What I do is I go out here, believe it or not, and I just buy that first option I get for a nickel. All right. And that defines the risk and makes it okay to the regulators. It'd probably be like the 75 strike on the upside or something. But the reason why I do that is just to say it's defined risk. It meets the rules. Now, don't hold that as, all right, I'm out if it goes down there. No, that is a lot further of a move than I would be willing to take against me. We're going to get out based on the swing trade getting broken. We got involved in it on the swing trade. We're getting out on the breaking of that pattern. So max profit is the credit. Max loss is unlimited. Now, to figure out your break even, though, you take your credit and add it to the calls or subtract it from the puts. All right. So you add it to the calls. I got set. My strike is the 70 call plus the 271. So my break even to the upside is 72.71, right? And then the 70 puts minus the $2.71. Because if I get a credit, I have to look, I get to keep that credit. So that means that I don't lose money until that credit is kind of eaten up. All right. So that's why to the upside, we get that credit. And to the downside, we get the credit to help us out as well. So the break even to the downside is 67.29, right? So those are our areas where we're going to be very concerned about looking for that support and resistance. Now, here is the curve. You can see that this would go on indefinitely as a loss because there's no defined risk strategy to it. But this is what it's going to look like. Very similar to the iron butterfly, but the iron butterfly, if you guys remember, we got a situation where it defined that risk. Okay. This one is not defined, but we get a much better credit than we would with the iron butterfly. So you can see here, my break even to the upside, they added the 270 in and it drops. It might take 5 years for me to get used to the new PowerPoint because that's how long I use the old one. All right, so right here, 270, you can see that's kind of lining up there, and to the downside, the 67.29 or 67.30 in this case. To the downside. Okay. Won't the stock or ETF drop in price with volatility? Well, the ETF, the volatility, the ETF isn't going to necessarily affect the volatility, vice versa. If the ETF were to drop in price, then we a lot of times actually will see volatility expand or go higher as people are buying puts. What happens is volatility spikes when people are buying options, all right? It's because, you know, if I buy it and it goes higher and I'm buying it again and it goes higher, the price is going higher, right? So that's driving volatility higher. So as underlyings go down and people are buying puts, they're trying to protect themselves to the downside. That increases volatility. And anymore, especially the more and more popular options are getting, we're seeing that even on the upside, FOMO, fear of missing out, people are going out there and buying calls left and right and driving that price higher. Okay, so calls can drive the price higher as well. Usually when we see the underlying settle down, that volatility comes out. All right, that's usually what we see. Sometimes volatility does spike, though, in some cases where we see that underlying settle down. And believe it or not, we got an example. All right, so underlying, I'm expecting to settle down here. I would get out above. I have a different Fibonacci on here. Let me see if it's on my other chart here. So I've readjusted these to the pandemic high and low. So you can see here, my strike location was right there at the 70 strike, 70 strike in this case, but I've got a Fibonacci right here at the 71.1 area. Why does it look like I have a pin and then? So we added in that credit to the upside. My break even to the upside was that 72.70, I believe. Oh, it went back. Oh, that's why I'm not getting it. Because my pen doesn't work on this. I've got to do a different pen. Sorry, folks. Try and get this together here. Here, we'll do this. We'll use this pen. So that's 72.70. 72.70 is my break even to the upside, right? Because I did the 70 strike plus the $2.70 collection that I got. And then to the downside, we were talking right around that 67. So 70 minus that 67.20 area, lining up right close to where we are looking at with this support level. That 50-day simple moving average was right there. So during this time when we got involved in this underlying last Friday, this was that candle that made it look like it was a topping pattern on my screenshots. Well, at the end of the day, it ended up rallying up towards those highs. And the next day I put that underlying on, but I used different strikes. I used the 69 strike. But anyway, during this time, I have correctly gotten this sideways move, right? 7 days have gone by. I've gotten 7 days of that theta eroding those premiums. One thing to note, look at this little number over here on the side, 17 and a half. It actually increased a little bit. It was up to 19 earlier today when I was taking my screenshot. Volatility did start coming out a little bit today. But what I was going to show you here in a screenshot, I'll just go ahead and go on to it. Let's get rid of this. Put this over here, get it out of my way. So let's move on to, let's fast forward here. Sorry, I got to get rid of all this other stuff. Can we fast forward, folks? Yes. Fast forward here. This was what we were taking a look at earlier today, was the 19. So today, that volatility did continue to increase a little bit. I got this sideways market. We are going to see that I'm very close to where this underlying was trading a week ago. So I've had 7 days of theta decay. Now, we talked about this. Every day that goes by, my theta is going to decrease by the corresponding amount. And I got volatility moving a little bit higher on my screenshots. So when I took a shot of this, look, the price, if I were to try and get out of this 70 strike. So you can see that I did actually do the 69s the next day, but I wanted to keep the screenshots together here, especially for this example. We can see that the underlying is really, when I took the screenshot, trading a couple of pennies away from that underlying is. But to get out of this trade, it went from collecting 270 to now I got to get out for $2.78, losing 8 cents. Which, keep in mind, this is a contract multiplier, so 8 cents is basically times 100 is $8. All right, so that's substantial, especially if you think about it consistently happening. So back to theta. Theta is a negative on both sides, right? I talked about this. I've had 7 days of theta. So we can see that these premiums decreased by 7 cents. These premiums, I could say almost 14 cents. So about 21 cents total coming out of these, right? 7 cents here. We can say this is 14 cents. But Vega has increased 2 percentage points. It went from basically that 17. Actually, it's really 3 percentage points from the first screenshot. So let's say it's 3. It went from that 16 and a half from that very first screenshot when I first showed you guys this when it was around 270. 3 percentage points. Well, 3 percentage points times 9. 3 times 9 is what? Anybody got that? 27, folks. So we're looking at, 27. So we're looking at just on this one increased by 14 cents. This one decreased by 14 cents. This one increased by 27, right? So, and this one was very similar, right? So we can look at the Vega here. This one was 7 cents. It decreased by this one, 27 cents. So basically we throw all that together. I've got 21 minus 54, right? So basically 33 cents-ish it increased by. Now, we can see that it's not quite that much because of the levers and pulleys of some of the other things that are going on with the gamma, and my theta has slightly increased more over that time. I'm giving that a little bit more credence, and this Vega coefficient probably jacked up. But at the end of the day, you can see why this volatility just increasing is really the reason why this strategy isn't working out. I've gotten that sideways trade. A lot of people don't understand the levers and pulleys of this type of strategy. When you're selling an option and you get this underlying moving the correct way you wanted, but something else is happening. What is it? It's probably one of the most misunderstood is Vega. All right, because this volatility is fluctuating. We can look at this underlying not go anywhere and see these premiums adjusting, and people don't understand why. Okay, it's because of that volatility fluctuating. Right? Does that make sense to everybody? If it does, smash that like button, feed those bots. Or comment if it doesn't, please. All right. If there's no other questions, comments, I will, if you guys throw it in there last second, circle back around. We'll go back and look at it. But if you guys want to learn to trade options like I do, throw this in your chat window. I don't have it in the chat window. I'll throw it in the chat window. Give me a second. I'll throw it over there in the chat window for you folks if I get a moment to find it. You guys get... punch it into your URL also if you are not able to click on the link here, because this guy is forgetting to copy and click on it. Let's see if I can do it this way. Let's see if this works. Appreciate it. Thank you, Jeff. I do appreciate the kind words. All right, let me see if I can get this out of the way. Throw this over there, and boom, should go in there for you. All right, there you go. If you guys want the hot link, I've thrown it into the chat window over there. You can click on that to get this offer. Listen, folks, a lot of people don't trade with the market profile, and I think they should. Why? Because it's the psychology of the market, and I talk about how to trade that in this. And the reasons why I do. It goes all the way back to the floor. This is where this started out. It used to be called Stoudemire's and Stoudemire theory. And it was a floor trader that came up with it. It is brilliant. It really is the psychology of the market. This is also what you'll find when you click on that link. It'll go to this page. It's a lot more than what I just showed you. As a matter of fact, folks are talking about rising interest rates. If you don't have this in your portfolio, oh, the struggles. The struggles are real. All right. How to protect your portfolio with rising interest rates. Take advantage of that one. It's a good one. Some fun ones. The history of options. There's your market profile. Gamma. I talk a little bit more about that one. So listen, folks, for 36 cents in option speak times 100, which is $36, because you got the option contract multiplier. If I can save you 36 option cents, then this is worth it, really, folks. For not screwing up on one option contract, you guys should educate yourself. That's how you're going to get yourself an edge, all right, is to educate yourself. Wouldn't you rather spend the money on $36 and go through a couple of videos rather than the angst of why the heck is this underlying trading sideways and I'm losing money? I did it just like he said. Well, maybe it happened to you. What's happening to me, and volatility is slightly increasing. I got the directionality right. Sometimes that volatility will throw us off a little bit. Are we still frozen? Do you put this trade 7 days before earnings or earnings was considered? I would not put this trade on right before earnings. This is an ETF, so it doesn't really have earnings. I don't care about the earnings necessarily so much inside an ETF because one is usually not necessary unless it's the highest holding, like an Apple or something. But unless it's the highest holding, I'm probably not going to worry too much about that underlying having an earnings so much. I think it'll get melded out a little bit. The other part of that question was, would I put this trade on 7 days before an earnings? No. I would put this on the day or the night before that earnings. Okay, that's how I trade earnings. Check it out. I have webinars on how to trade earnings specific, and we are heading into the earnings season, so maybe I should be offering that for a discount so you guys can take advantage of that. But earnings trades, folks, those are some of the most fun because you get in and out quickly. John, what do you got for your question? Jeff, do I still look frozen? All right, I think it's still working. I got time for you, John. If you guys have any other questions, comments, or you have ideas for me to do on future webinars, reach out to us at 310-598-6677. Smash that like button, feed those bots. Seriously, folks, if you have any questions, throw it over there. I will circle back around and make sure you subscribe. Why? Because that subscribe button will let you know when I'm going on. And there's a little bell that will tell you when I'm coming on unannounced. So that will let you know when I'm talking about my trades. All right. I've got it. Can you clarify how you read the monkey bars, the numbers in the volume profile? Yeah, I can do that real quick. Let's go back to the profile if I can find one rip through here. There we go. There we go. That's a clean one. So the idea here is, as the blue is basically the volume. That's where we actually transact. You and I are trading, slapping around 100 lots. I'll sell you 1,000. Boom, 100, right? That's when we're slinging them. That's transaction. Now, today, XYZ is just trading 70 all day. Well, that's where we'll get those little, that's where the volume profile numbers come in. So I'll try and zoom into this. Oh, what? The big one. So actually, that actually worked out pretty good. So you can see over here, the blue is the volume. That's where we're trading. That's where volume's being noticed. But here, you can see these numbers. They're different colors also. They're different colors because they're different days. Okay. And how do I get that to slide? So a different day might have a different color, but the time bracket. So let's say the market opens at 9:30 Eastern. That would be a 0 time bracket. 9:30 to 10 is 0. Now 10 to 10:30 is 1 bracket. 10:30 to 11 is 2 bracket, okay, in a sense. So that's telling us, all right, it traded at this price during that time bracket. It doesn't say, okay, it traded there at this time bracket in 2 bracket. It traded there again. It doesn't add another 2 on there. It's already traded in that time bracket. So the 2 is already indicated. So it can go up and back. It's just going to have that one time frame, all right? But the time nodes, when they stack up, you know, the idea is people have gotten used to seeing this price, so there's no real angst. And the same goes for transacting. If you and I transact at this price several times, or we've just seen this price at that level, we don't have any real angst to get in or real angst to get out, okay? We're just kind of complacent here. Does that make sense? So the idea is when the volume node really starts getting big, I can't get my thing back. All right, everything got wanky. Anyway, so when this volume right here at $63, that's what we say, that's where the market has accepted value. Meaning that's where we believe the most people have transacted. That's because most people have either bought it or sold it there. That's where value is created. And in this regard, I'm seeing this volume node because it has the moves. It's got a volume node there. I believe it's going to build this out a little bit more and get more complacent. Does that make sense? So the numbers are the time brackets, and a new time bracket will get a new number. A different day will get a different color, okay? And they'll stack up. So let's say Mondays are always red. Fridays are always green. I don't know if that's necessarily the case. I don't really care what day is what. I just want to see where they're all stacking up. Okay? All right. Without further ado, make sure you guys smash that like button. Feed those bots for me, please. Get those bots running out there finding somebody just like you. Hey, subscribe, hit the bell. That helps feed those bots. And comment, even if you are watching this on tape delay. I'll come back around, folks, and make sure you guys are clear of concept. I'll touch base with you. Finally, if you can't take that, take it easy. Bye now. For mine, the time brackets are the 30 minutes, yes. You can have it set, if you do it on your 15-minute, it should set it up for the 15s. Bye, folks.